If you're a roofing or restoration owner, or really any business owner, and at the end of each month you feel like there should be way more money in your account than there is, then you need to watch this video. Today I'm going to break down one of the most impactful business books for entrepreneurs who are struggling to figure out where all the money went. And it's called Profit First by Michael McCalla. Now, this is especially relevant for contractors working on insurance claims, because neither you nor your customers control the timing of the money, and that can wreak havoc on your business's cash flow cycles, like majorly. My name is Matt Fruge. I'm the CEO and co-founder of SquareDash, which is a fintech platform aimed at helping insurance restoration contractors get paid faster, turning every claim into a retail deal, getting you paid just within a couple of days. And before this, I was a roofing contractor for 15 years in the Dallas-Fort Worth area, so I've literally seen it all. And if you like the content here, please hit the like and subscribe and bell button. Just stay up to date as we try to bring you more valuable insights from the industry. So, all right. Let's get into the good stuff here. What's wrong with my business? So traditional business accounting says start with your income, subtract your expenses, and call the difference profit. It also recommends that growing your business should be your top priority. However, this approach can actually be kind of dangerous because it clashes with how most people think and make decisions. Business owners often think that they should reinvest their money back into their business for growth. But this can actually make the business really unstable as it creates super high cost and it eliminates all your cash on hand. And this instability can make a slow sales period super fatal for a business. And a lot of contractors become used to the extra expenses that they've reinvested their profits on and don't really want to get rid of them. They might have a hard time recognizing that they don't need that lifted truck or the big office space that they've grown accustomed to, for example. There's probably a million other things, boats, four-wheelers, you name it. Like, there's probably stuff that they don't need. And, research on compulsive spenders supports the argument that people attach emotions to the things that they buy, right? Which makes cutting expenses really difficult. And people tend to believe that buying things will make them happier or compulsively buy as a way to try and cope with the shame that they feel. Now, another thing contributing to this instability is that financial statements are often really complex and difficult to navigate, even for accountants. And it can make it really difficult for business owners to even recognize when their business is financially unstable. I don't know if you know this, but nearly 40% of all small business owners would label themselves as financially illiterate, and 66% wish that they knew more about their finances. So there's a big gap here. And also, financial instability and uncertainty often lead business owners to make irrational or panicked decisions, which can only put the business further into trouble. And often these decisions involve looking for increased growth and sales, even if they come with expenses or opportunity costs. And as people lose money, they will actually make worse financial decisions. A study also found that as gamblers lost money, they would be more likely to recklessly and impulsively spend more, believing that doing so would actually help them earn their money back. And the same study suggests that this is because losing money is an emotional event, and so it doesn't encourage rational decision making. And this same research can be applied to business because it suggests that business owners who are losing money growing their business will psychologically want to spend more money on growth to chase that success. I don't know if that's ever happened to you, but it certainly has to me. And this is where Profit First enters to save the day. The Profit First method has 4 core tenets to help entrepreneurs make healthy financial decisions. Tenet number 1, limit your resources. By allocating only a percentage of your income to expenses, you'll actually force yourself to spend that money more efficiently. And the theory is that the more resources we have available, the more resources we will use. Theory works in the opposite way as well. The fewer resources we have available, the fewer we will need to use. Tenet number 2, order things in terms of importance. Now, this tenet says allocate your income in order of importance, starting with profit. Emphasize that that is your first priority. This works due to what psychology calls the primacy effect. When given multiple pieces of information, our natural tendency is to better remember and place the more importance on the first thing that was given to. And this moves into tenet number 3, removing temptation. You need to remove the temptation to reinvest money into growth by creating savings account for profit and other essentials and making those accounts inconvenient to access. By making that money harder to access, you'll actually be less tempted to misuse it. Tenet number 4, final tenet, is keep good habits. You want to make a habit of dividing your income between profit and expenses and paying your bills consistently. By making a habit of dividing income amongst your business bank accounts, you can recognize financial changes just by looking at their account balances. And then you can react to those changes calmly because you'll have seen them coming. All right. So we understand the 4 core tenets of the Profit First method. How do you set it up? First, you're going to open 7 new bank accounts, really 6 if you already have one. I know that may seem like a lot, but it's it's not. You're gonna have 5 checking accounts and you're gonna have 2 savings accounts. For the 5 checking accounts, you can open these at your primary bank that you're already using. You're gonna use these to keep track of your income and where you're gonna allocate it. And the first account you're gonna set up is your income account. This is the account where all of your deposits will initially go before being transferred to your other accounts. And doing this allows you to easily see your total revenue before you divide it up. The second account you're gonna set up is your profit account. This is where you're gonna put your profit when you subtract it first from your income. Doing this before the others reminds you that this profit is your first priority. Third account, salary. This account will be where you delegate your own salary. If you're not taking a salary, start tomorrow. You need to be taking a salary from your business. It's important to establish a regular cadence of paying yourself, and it's also important to show, especially if you're ever gonna sell the business, like you need to record what you make. It can't just be this willy-nilly use the business like an ATM. You can also label this as owner's compensation. Very important account. Fourth account you're gonna set up is your tax account. This is the account where you'll first place your money allocated for paying all your taxes. Number 5 is your expenses account. This is where you can use your existing business banking account for all your main expenses. You probably already have debit cards and bill pay going out of that, so it should be pretty easy to just use that for your expense account. And this is so you can continue the habit of making financial decisions based on your bank balance, but it'll also have the appropriate limits placed on your available spending money. So then, in addition to your checking accounts, you're gonna open 2 savings accounts. You're gonna do this at a separate bank because you're gonna make them inconvenient to access. This goes into the tenet of reducing temptation because you're gonna make it hard to get what you want. In this case, making it harder to spend the money in those accounts on other things. The first savings account you're gonna set up is your tax savings account. This is where you're gonna transfer the contents from your taxes checking account into this account on a regular basis. Then the second savings account is gonna be your profit savings account. And same thing, you're gonna transfer the contents of your profit checking account into this profit savings account on a regular basis. Now, after you get your account set up, you're gonna go through an exercise where you're going to assess your business's current financial health by finding the percentage of your income that you're spending on each aspect of your business and compare it to a healthy business's percentage. Now, while this section provides a guide on a simple way to assess your business's financial health, it isn't as comprehensive as what a skilled financial advisor can offer, especially one that's familiar with your business. So please don't use this as a substitute for that kind of support. Okay, so to find what percentage of your income is allocated to each aspect of your business, you're gonna do a few things. First, you're gonna find your total income from the last 12 months. Now you're gonna add up all the expenses that you spent on material and subcontractors, and you're gonna label these costs as M. Then you're gonna subtract your material and subcontractor cost. You can also think of that as your cost of goods sold, right? You're gonna subtract your material and your subcontractor cost, M, from your total income, find your adjusted revenue. And you're gonna label this R. Now, then you're gonna find out how much money went into the following areas. First, profit. What was the profit from last year that you didn't reinvest into the business? Like how much money did you actually take out of the business as profit? 2, what was your salary? Your salary from last year. 3, taxes. How much of your business's money you used to pay your taxes last year? And if you use your business's money to pay your personal taxes, include that amount here as well. Fourth thing, expenses. You're gonna add up all your expenses from the last 12 months minus your cost of goods sold. Once you have all those numbers, you're gonna divide each of those values by your adjusted revenue that you got up at the top to find what percentage is allocated to each of those areas. Now you can compare your percentages to the table displayed on the screen for an appropriate adjusted revenue bracket. And the closer your percentages are to those in the table, the healthier your business is financially. And while these are good general examples of where a healthy business allocates its income, it's really important that you find your own ideal allocation percentages. And so they may not be applicable to whatever industry you're in, but once you determine these ideal percentages, you can think of them as good initial goals for your businesses. They shouldn't remain fixed forever. You're likely gonna have to make adjustments over time and adjust those to your business's needs and circumstances. The first one you're gonna wanna figure out is your ideal profit percentage. It's number 1 on the list. To find your ideal profit percentage, you're gonna look up maybe the records of successful public companies in your industry that are similar to your business's size. It can be difficult to find privatized financial data, but you need to find some kind of reference data to figure out what their profit was against their revenue. You're gonna divide that profit by their revenue for the past 3 to 5 years, and that average of those years should give you a good idea of an ideal profit percentage. The second thing you're gonna figure out is your ideal salary percentage. Now, to determine this, I recommend that you pay yourself the same amount that you would pay an employee to do your work. You're gonna divide this salary by last year's adjusted revenue for your ideal salary percentage. And the notion here is that a CEO with low pay will work harder to help the business succeed since they won't just be getting paid for showing up. In addition, a CEO with low pay inspires other employees to work harder by showing their dedication to the company. And also keep in mind, you're going to be able to access your profit now because you're going to be allocating it. So this isn't the only income that you're going to derive from your business. So just keep that in mind. So you shouldn't go overboard with your salary. It should be, reasonable for your industry. Next, you're going to find your ideal tax percentage. To find your ideal tax percentage, like this is going to cover your business's taxes and your personal income taxes combined. You're going to find your ideal tax percentage by adding the amount you paid last year on your business and personal taxes together, and then divide that number by your adjusted revenue from the last year. And when I say business's taxes, this could be a number of possible taxes depending on what your business does and where it's located. So be sure and check with your accountant or the IRS website for a list of all the taxes your businesses might have to pay. Now, the last is your ideal expense percentage. To calculate this, you're going to subtract your profit, your salary, and your tax percentages from 100%, and the leftover that you get will be the money you use for expenses. Great. Now you've found all of your ideal allocation percentages, but it's important that you don't try and match them too quickly. If you allocate too much money away from the expenses you currently have, you're going to end up without enough money to run your business because it's probably not running at ideal percentages right now. Instead, you're going to want to gradually change how you spend your money. When you change your current percentages to meet your ideal percentages, start by only changing 3%. That can mean if one is over your ideal target, take 3% from that and add it to the percentage of something that's way below what it should be ideally. So if you're like 6 or 7% below your ideal target, but you're 3 or 4% over on another, take it from there, move it to there, and adjust it accordingly. Then you're going to want to allocate your business income to your bank accounts and pay your bills twice a month. This is so you can keep track of how you spend and when you spend it. Now, I know what you're thinking. If you're a contractor, you're like, my guys need to get paid on Friday. Your guys will get paid when you tell them they're getting paid. So take control and say, hey, we're changing to a bi-weekly pay period. You're gonna get paid every 2 weeks, and that's the end of it. If you don't like it, go find someone else to feed you. Just do it. Get on a normal, regular, every other week pay schedule and pay your bills twice a month. Because if you have less money than you thought you would when you're paying your bills consistently, that means your business is experiencing cash flow issues. And if you work in the insurance restoration industry, you most definitely have a cash flow problem. And that's where Square Dash can help out. So, okay, but now, what do you do next? You're gonna take half of the money in your profit savings account. Each quarter, you're gonna take half the money in there and you're gonna give it to yourself as a reward for doing things the right way. And then you're gonna leave the rest of the money in the account as an emergency fund. And if for some reason you don't want or don't need all of the profit for yourself, don't automatically plan on reinvesting that back into your business. Instead, consider giving some of the profit distributions to your employees by setting up a profit sharing plan as part of their retirement fund. It's an estimated 19 to 23% of US businesses that do this. You should become part of that statistic and take care of your employees. Now, using this method long term, there's a lot of setup and a lot of changes you gotta make in the business, but what are you gonna do moving forward? Once you've got it set up, this is really gonna help improve your financial stability and the profitability of your company because you're prioritizing the profit first. And as you increase your profit percentage, you'll need more money available for your profit allocation. However, increasing your income is not how to get this additional money the best way, because cutting expenses is actually a faster and easier way to make that money available. After you've been doing this for a while, you're gonna compile a list of all the expenses from the previous year. And then for each expense, you're gonna ask yourself, is this necessary for keeping my business running or making my customers happy? And if the answer is no, or maybe, or kinda, if it's not a clear yes, cut the cost. And if it is a yes, figure out a way you can accomplish the same thing in a cheaper manner. And this will give you a disciplined and methodical approach to reducing expenses, which is always a better way of unlocking margin than trying to go achieve more sales. Because sales brings with it customer acquisition cost. Cutting expenses doesn't bring any additional cost with it. So that's it. That's the profit first method in a nutshell. And it's really what thousands and thousands of struggling business owners have used to transform their business and avoid total, complete business failure. So I really hope this video was educational and informative. I highly recommend you go get a copy of the book. It's all an audio book. You can listen to it. However you need to consume this book, you should. There's a workshop that you can take. There's professionals out there that can help you implement this into your business. But as a roofing and service-based business, you owe it to yourself to dive into this book and really understand the principles that it's teaching, because it's so overlooked and it's the reason why so many small businesses fail. So if you like the content, please like and subscribe to the channel. We just want to bring you more educational and valuable content. And until next time, keep killing it. Thanks.